Welcome to This Explainer. Okay, right off the bat, I need you to completely shift your mindset. Today, we are putting on our venture capital hats and stepping straight into the Silicon Valley boardroom. I want you to think of me as your personal pitch doctor, your chief technology investment officer, and we are going to look at your Cambridge 9706 accounting exam through a totally different, highly analytical lens. Look at the grade valuation meter on your screen. That is your potential. We are mapping your baseline knowledge all the way up to that top-tier million-dollar marking band. Think of your exam marks as hard capital. Your examiner, they are the ultimate ruthless angel investor. They are sitting across the table, deciding whether to fund your final grade or completely pass on your pitch. And in this specific syllabus, marginal costing, and specifically the concept of contribution calculation, well, that is one of your absolute most valuable assets. It's the core engine of your business model. But here is the massive catch. It is also one of the most frequently mismanaged assets on the entire balance sheet. We see brilliant candidates crash their valuation right out of the gate because they don't know how to pitch their data. So let's fix that.
So this brings us to a massive, literally $1 million question. Why do so many incredibly smart students completely bankrupt their marginal costing scores? It's a critical pain point in the market. If we look at the official data, the principal examiner reports continually flag contribution calculation as one of the single most misunderstood areas in the entire Cambridge 9706 syllabus. I call this the drifting MVP pitch, the minimum viable product that just goes nowhere. Year after year, candidates walk into that exam room thinking they have a unicorn valuation. They think, hey, it's just sales minus variable costs, right? Easy money. And then they see their marks absolutely crash. Why? Because they leave points on the table by treating this topic like a basic, low-level math problem rather than a strategic, top-tier financial analysis. They give a descriptive pitch instead of an evaluative framework, and they lose their valuation margin instantly. We are going to lock in your funding today by restructuring how you approach these high-tariff questions.
Okay, let's dive into this investment prospectus. Here is exactly how we are going to build your exam skills step by step today. 1. The valuation baseline. 2. Procedural framework architecture. 3. Identifying compliance liabilities. And 4. The final evaluation and audit.
Let's start right in with Phase 1, the valuation baseline.
The absolute foundation of your business model, the core code of your software, so to speak, is the contribution calculation itself. Now listen closely, because this isn't just about plugging numbers into a formula and subtracting variable costs from sales. According to the syllabus, this framework rests heavily on precise definitions, understanding strict causal relationships, and, this is the absolute big one, the real game changer, integration with other syllabus areas. The examiner reports are explicitly clear on this. Candidates who reference cross-topic connections achieve significantly higher marks. Showing that you understand how marginal costing impacts other financial structures, like pricing strategies or make or buy decisions, is the key asset flow that drives your baseline valuation through the roof. It proves to the investor, your examiner, that you see the whole macroeconomic picture of the business, not just one isolated, siloed metric. You have to understand that contribution is what pays off your fixed costs, your burn rate, to eventually reach profitability. If you can't explain that flow, your pitch is dead on arrival.
The Cambridge Assessment Framework is incredibly clear here. I want you to read this quote. Top-performing students exhibit connected, conceptual understanding transferable to unfamiliar contexts. The examiners are actively, aggressively testing whether you can take the core principles of marginal costing and apply them to a completely bizarre or unfamiliar business scenario. To really understand this, I want you to imagine two founders pitching to me right now. Let's call them Alex and Sam. Alex is our highly technical developer. Alex overloads the slide deck with raw code infrastructure data. We're talking pure assessment objective 1, AO1, raw knowledge and facts. Alex dumps every textbook definition of marginal costing onto the table. But Alex lacks a clear business monetization strategy. There is absolutely zero evaluation. Then we have Sam. Sam is the charismatic marketer. Sam delivers highly persuasive, beautiful narrative pitches saying, oh, the company should definitely accept this special order. It's a great opportunity. That's a nice story. But Sam has zero data backing up the assets. Sam completely misses the command word constraints. No AO2 application, no AO3 analysis. The benchmark prioritizes analytical depth over superficial breadth. You can't just be an Alex and you can't just be a Sam. You can't just skim the surface with a nice story and you can't just dump raw data. You need to merge those skills. You have to prove deep, evidence-based, structured reasoning to secure that top-tier A-star funding.
Moving right along to Section 2, Procedural Framework Architecture. So how do we actually merge Alex's data with Sam's narrative? We need a strict operational execution phase. Let's walk through this standardized 6-step sequence. Think of this as your strict manufacturing pipeline, designed specifically to secure incremental funding through what I call the method mark strategy. Imagine Alex and Sam in the tech war room right now. The countdown clock is ticking, and they need to build an unassailable model response. Here is their blueprint. Step 1. Deconstruct the question. You literally have to decode the command words. Are they asking you to state, calculate, analyze, or evaluate? If you calculate when they ask you to evaluate, you've just breached your contract. Step 2. Extract relevant data. You have to pull the exact figures from the stimulus materials and filter out the noise. The examiner will throw in sunk costs and fixed overheads just to distract you. Ignore them. Step 3. Select your analytical framework. Are we looking at a limiting factor scenario or a simple break-even? Step 4. Execute with clear notation. Show every single step of your math. Step 5. Verify your results for reasonableness. Does a negative contribution margin actually make sense here? Probably not. Step 6. Present with correct terminology. Now, why is this so absolutely crucial? Because in the method mark strategy, the logical process itself awards marks. Let's say you hit a system bug in step 4, and your math is slightly off. If you use the proper framework, this systematic processing mitigates your risk. The examiner can follow your logic, and you still capture the vast majority of the available funding. You are quite literally building a safety net into your pitch.
And speaking of that final presentation step, you have to follow strict conventions. This is your compliance check. Look at these requirements: proper headings, correct terminology, appropriate formats, and clear annotation. Think of this as your required formatting compliance for this specific syllabus area. I want you to really visualize this. If you walked into a Silicon Valley boardroom and pitched a $10 million startup to an elite investor, but your financial projections were scribbled in pencil on a crumpled napkin with no headers, no units, and no clear bottom line, they would literally laugh you out of the room. The Cambridge Examiner is exactly the same way. Systematic analysis and clear working are non-negotiable, established principles. If you just write down a magical final number with no trail of evidence, the investor cannot audit your work. No audit, no capital. It's that simple.
Let's pivot to Section 3, Identifying Compliance Liabilities.
Valuation pause. Okay, right before we unlock the top band paragraph architecture that is going to completely scale your final grades, we need to optimize your educational asset flow. Take a second right now to subscribe to Ace the Exams at the handle @AceTheExams and turn on all notifications. Whether you are hacking exams at IGCSE, O-levels, or pushing through AS and A-levels, you do not want to miss our weekly high-yield strategy drops. Hit that bell. All right, let's get back into the boardroom. Look at the market risk chart on your screen. Year after year, the principal examiner reports show the exact same 3 fatal pitfalls. And this brilliantly illustrates where your competitors are losing their valuation margins instantly. First, we have cause and effect confusion. This is when students mix up what drives what in marginal costing. They treat fixed costs as if they vary with production, or they misunderstand how a limiting factor distorts the contribution per unit. Second, presentation and format neglect. As we just discussed, failing to provide headings or clear working destroys your method marks. It's a completely unforced error. Third, and this is the absolute most fatal liability, generic contextless answers. This is where the whole pitch falls apart.
I am issuing a massive examiner alert right here. Look at this comparison. Providing generic textbook definitions that lack specific scenario links is the ultimate compliance liability. Let's go back to our founders, Alex and Sam. They are mid-pitch, and suddenly they hit an unexpected system bug. Their evidence links completely drop out. They are standing on stage defining what contribution means in perfect textbook English, but they aren't telling the investor what it means for this specific company in the case study. Their valuation is crashing live on the meter. How do we fix this logic flow instantly? We use a structural optimization matrix, what you might know as the Peel structure: point, evidence, evaluation, link. To build a high-value asset, you must anchor every single analytical point directly to the given business context. You cannot just say, the company should prioritize the product with the highest contribution. That's generic. You have to say, because machine hours are the limiting factor, the company must prioritize product Y, which yields a contribution of $15 per machine hour, thereby maximizing total profitability under the current capacity constraints. Do you hear the difference? That is data interpretation. That is extracting specifics, interpreting relationships, and drawing evidence-based conclusions. Presenting a descriptive copy-paste pitch instead of an evaluative, context-specific framework guarantees evaluation crash.
This brings us into the final phase of our boardroom audit, Section 4, Final Evaluation and Audit.
I am handing control over to you for a live compliance audit challenge. Let's outline the ultimate problem-solving loop to lock in that A-star valuation. Step 1. Deconstruct given information. This is your rapid market scan. Imagine a complex data chart on the screen with a 60-second visual countdown. You have to isolate the single highest value core trend immediately. Step 2. Solve systematically. Run the numbers through your marginal costing framework. Step 3. Evaluate and make justified recommendations. This is where you identify the compliance liability in a flawed response. Top-scoring evaluative thinking requires questioning assumptions. What if demand changes? What if the variable cost of materials spikes next quarter? When you do a comparative analysis, you must identify both similarities and differences. You must use comparative connectives like whereas, conversely, or on the other hand. You have to support every single comparison with hard evidence from your calculations and then draw concrete conclusions about relative importance. You must justify your final decisions. The examiner needs to see that you aren't just a calculator, you are a strategic financial advisor. You have to prove why your recommendation is the absolute best use of the company's capital.
Now you might be wondering, how on earth do I remember all these operational frameworks, these steps, and these peel structures during the incredibly high-pressure environment of the real exam? Your brain is going to be running hot. Here is a specific high-yield retention tactic pulled straight from the source material. Use the visual story method to encode these complex contribution calculation concepts. Instead of just rote memorization, which is incredibly inefficient, create a vivid, visual, step-by-step narrative in your mind. Imagine it like a giant puzzle. Picture a literal factory floor producing goods. Visualize the raw materials and the direct labor. Those are your variable costs, attaching themselves to every single unit moving down the conveyor belt. Then picture the selling price. The difference between those two, that is your contribution margin. Visualize that contribution margin flowing into a giant bucket. That bucket is your fixed overheads, your rent, your salaries. Once that bucket overflows, every single drop after that is pure net profit. This visual storytelling is a massive memory hack. It will help you instantly recall the procedural architecture and that deconstruct, solve, evaluate loop when the clock is ticking and the pressure is on. It turns abstract math into a tangible physical reality in your mind.
Alex and Sam just delivered their newly engineered context-driven response paragraph, and their grade valuation meter just peaked at the maximum A-star score. They secured the Series A funding. Let's distill today's session into 3 universal rules for your own exams. Rule 1, the 3-step question scan. Decode the command words immediately. Rule 2, the scale budget allocation. Time your math perfectly so you leave room for analysis. Rule 3, the final quality review checklist. Anchor your evidence to the specific business context. You now have the exact pitch deck to audit your marginal costing answers, so I leave you with this final provocative thought. Are you walking into that exam room just to crunch numbers, like a basic calculator, or are you ready to actually evaluate the business and demand top-tier funding from the examiner? I want to hear from you. Subscribe to Ace the Exams at @AceTheExams, click that notification bell so you never miss our weekly grade masterclasses, and drop a comment below right now sharing exactly which Cambridge subject and level, IGCSE, AS, or A level you are preparing to conquer next. Keep evaluating, keep securing those assets, and I will see you in the next explainer.